Okay, we're going to be talking about the economy and economics today. And some of you may come from an economics background, some of you may not come from an economics background. How many engineering students do I have here? Got one engineering student. How many physics or astronomy students do I have? No physicists here. Okay, you're the one who comes closest to it. I think there are biologists and chemists here, aren't there? Yeah. Okay. You may or may not have read economics as part of your undergraduate studies. Some of you may have read economics, but it's so long ago. Some of you may have done a specialist degree in economics, in which case you can use this as a refresher. So either way, I need to bring all of you onto the same page. And that's why I'm talking to you about economic data. And understanding the economic data is very important because the economic data, or the publication of economic data, or the expectations created by economic data actually affects the value of the markets. Okay? And when I talk about economic data, I'm talking about the macroeconomic data. Now, one of the variables you will see commonly spoken about in the financial press is this thing called gross domestic product, or GDP. GDP simply is the value of all goods and services that are produced within the economy, and GDP and what economists look for, and what financial markets look for when they look at GDP is not simply what is the GDP, but how the GDP is changing. Okay, so it is really the percentage rate of growth in GDP, and that gives an indication of economic growth. Okay, and that's what economists and financial markets actually look for when they consider GDP. So it's not just a GDP figure. This is the GDP, or this was the GDP pattern, or growth pattern for the United Kingdom between 2000 and 2009. I still haven't extended the data to cover till 2013. I'll get around to that sometime. But that's pretty much been the pattern of GDP growth. So on the y-axis, I'm plotting the percentage growth in GDP, and on the x-axis is the time. You can see it's been moving up and down, and this is sort of come down. It's been hovering between the 3%, the 2% mark, and then 2008, it's come tumbling down, and we are in decimal points of growth in terms of GDP. Interesting question is, what causes GDP to or the gross domestic product, or the economic growth, to slump? And it depends very much on the economy. In a case like China, the economy is driven by manufacturing and exports. So if you have a slowdown in the manufacturing sector and the export sector, you can have a slowdown you'll have a dramatic slowdown in growth. In the in the UK, the economy is driven mainly by services. So if you have people who are not spending, or people who are cash strapped because they cannot borrow cheaply, then you're going to have a slowdown in economic growth. So it's very important when you're considering economic growth to look at the economic sectors in the economy. What's actually driving this economy? What's the fuel in this engine? Okay. Another macroeconomic issue that will feature heavily when it comes to analyzing the stock markets is this inflation. Inflation is important. Inflation is simply the rate of change of price level, and one of the measures of inflation is the consumer price index. Pretty much like how you have your stock index, stock market index, you have the consumer price index, and the consumer price index, very simply put, is where you take a basket of goods. So you can take, for example, a loaf of bread. You can take a kilo of carrots, so on and so forth. And every year, or periodically, you would find out what the price is for each of these, right? And then you would compile and aggregate which represents um, the average price of that basket of goods. So what you cannot do is you cannot change the basket of goods. You got to keep the basket of goods the same, but what you're seeing is how their prices have been changing on average, right? And you have a starting point. You have what is called a base period. That's the starting point. It's like the device in your car that measures the distance traveled. What is it called? Mileage. The indicator. You reset it to 0, right? And then for every mile it travels, it clocks up. It's the same thing. The base period is when you reset it, and the base period is set to 100, right? And as the aggregate or the average prices change, it will actually increase. So if the average price today, if the CPI index today is 110, you can see that it's gone up by 10 index points. So the prices have actually gone up. So that's how you tell whether the prices have increased or decreased. And here again, what you're looking at is the rate of change of the consumer price index. The base period is always fixed, but the base period keeps changing because you cannot keep the base period in the 1960s, because in the 1960s, what are the items that made sense? Now you got to include new items like mobile phones, the new tablets. So the consumer, the average consumer goods have actually changed since the 1960s, right? So therefore the base period gets reset. It's like the mileage indicator in your car. After you finish the journey and you want to start another journey, you reset the mileage indicator. It's something like that, and then you start counting from that base period. Okay. And this is what the inflation rate in the UK has been looking like since 2000. You can see that since 2000 the inflation has been rising, and then it sort of peaked sometime here. The angle of trajectory has been a lot sharper, and then all of a sudden it sort of started a downward trend, and you can see 2008 is when everything sort of went south. Okay. Unemployment is another indicator. Before I go into unemployment, why is inflation important? Because inflation actually deteriorates the value of money. If a pound could buy you 1 can of Coke, and due to inflation, the price of a can of Coke has gone up to 2 pounds. What that's done is it's halved the value of your money. Okay, so inflation actually erodes the value of money, and investors are always trying to find investments that hedge against inflation, meaning that if the inflation rate is going up, they want to have an investment that have a rate of return that's over and above the inflation rate. If inflation is negative, not if inflation is slowing down, but if it is negative, we call that deflation. And deflation is very dangerous, because deflation shows that there are serious problems in the economy, that the economic growth has actually turned down, and that's even more dangerous than inflation. So it's not even deflation is very dangerous. Yeah.
Is there a law on rate of inflation, and that the commodities have to increase according to the rate of inflation?
There is no law as such. There are the investors who, if you're an investor and you're investing in a market or an asset, you want to make sure that in the long run your returns beat inflation. Because if it doesn't beat inflation, then even if the market has you gotten a certain return, then it's not really a profit to you. Say, for example, you invested in a market and the rate of return on your investment is 7%. So your ROR is equal to 7%. But inflation, let's say, is 3%. So inflation is 3%. So your real return is equal to 7 minus 3 is equal to 4%. So that's how much you're really getting back out of this investment.
So with that, keeping that in mind, then the best thing to invest is in the energy companies. You know, by the looks of it, the way they
Could be, could be, could be. Yeah, but that's something. I mean, I'm not going into the practical side of it, but on the principle side of it, as an investor, you have to keep your eye on inflation, because inflation actually deteriorates the value of money, and that's why during high periods of inflation, investors may want to take their money out of fixed income, because if you have fixed incomes like bonds, which have a regular return, then if the inflation is high, that fixed income is not going to really cover your real need, your real income, your real rate of return requirements.
This inflation rate, I think there's a guess it value in advance, is it?
Say again?
That guess the inflation rate right in advance?
You can forecast the inflation rate. There's no guarantee that your forecast is 100% accurate.
Yeah.
But the central bank does forecast the inflation rate. Yeah.
Because so far, why in the last 2 years, as soon as that it's going to be inflation is going to high, they are reducing the minimum wages as well. So as soon as the minimum goes high, I can expect that in a few months time period,
Yeah.
Some of the prices will go up as well. It happens like this as 2 years. But
Yeah. Yeah. Yeah.
Sorry, inflation is good for debts.
Yeah, it is. Yeah. The other factor, that economic indicator or economic factor you need to watch out for, is unemployment. In fact, employment data is coming out today in the U.S. How many of you are actually keeping your eye on that? Okay, not many. So now unemployment is important, because unemployment actually gives you an idea of the potential growth. So if the unemployment has gone up, that means people are making money, and people are making money, they'll be spending money. And if they're spending money, especially in the consumer economy, it's good news. It'll create demand in the economy. And if the unemployment rate shoots up, then you can expect the economy to gather momentum. So employment improvements or disimprovement in employment is sort of seen as a precursor or a predictor of future economic growth. So investors actually form their expectations based on unemployment results. Unemployment simply is the percentage of the working age that is unable to find work. So they're looking for work, they're able to work, but they simply cannot find work. That simply is the unemployment rate. And it is published regularly, it's published quarterly in most cases. In the US, you have something called the non-farm payroll. That is, and this is a figure that is collected from data relating to people who are employed outside of the farming industry, right? And that is one measure of predicting or forecasting unemployment. But the Bank of England also collates data on unemployment, and it publishes it quarterly. It also publishes forecasted data on unemployment. And unemployment is important because it gives the markets an indication of where the economy is going. If people are getting more and more, if more people are getting jobs, if the unemployment rate is going down, that means the employment rate is going up. Then you can expect the economy is getting healthier. Okay, and this is what's been the unemployment rate since 2000 to 2009. The unemployment rate has actually been going up since 2008, but it will be interesting to look at the more recent data to see how the unemployment is, whether it's improving or whether it's worsening. Now, Economies are not closed economies. Most economies are open economies, and when we say they're open, what does that mean? It means that they, what is that called collectively? They trade. Okay, they trade in physical goods, but also services. And there's also what we call the flow of capital. Investment actually flows between countries. Okay, and one thing that investors keep a lookout for is this thing called the current account. The current account records the value of exports and imports. Now, some countries like China, for example, have a very strong. You don't mind if I keep picking on China, do you? You're okay with that? Okay. China is a good example of an export-driven economy, and the current account in China is at a surplus. Now, what does that mean? It's at a surplus. Well, if the value of exports is greater than the value of imports, okay. So here we have the value of exports being greater than the value of imports. Here the country has what we call a surplus. Countries like the US and Britain have always been in deficit because the value of their imports is greater than the value of their exports. They are buying more than they're selling. When you export, you actually sell to the outside world, to other countries, and you earn money as a result. When you import, you actually buy goods that are produced abroad. You're buying from abroad, right? So if you're looking at the current account for the US or the UK, they're always there. You're going to hear a lot of speak about the deficit. So it's a question of, is the deficit getting bigger, in which case it's becoming more and more of a problem, or is it becoming smaller, which is good. Okay. For the UK, you can see that the current account has always been in deficit, right? And it went more into the deficit in 2005, 2007. But as a result of the global economic crisis, it's been actually improving, and that's sort of a mixed blessing. And the reason why it's improving is because, you know, people have cut back on their spending, and large part of what they cut back on is imports from other countries. Okay. So the current account balance has an impact, especially on the currency side. Because if you're importing more than you're exporting from a particular country, that means you have a greater demand for that country's currency. It also has an impact on the exchange rate side. On the treasury side, because there's a question. The question is, if you're importing more than you're exporting, and this is the situation I want to sort of explore here. If you're actually importing more than you're exporting, which is this situation, which is where we're at, okay, how can you do that? How can you actually import more than you're exporting? Normally what happens is you export and you earn money and you spend that on imports. Exactly. If you're actually buying more from abroad than you are selling to abroad, normally you earn your money by selling abroad. But if you're actually buying more, importing more than you're exporting, the only way you can do that is if you are borrowing. And this is the bone of contention between China and the US, because the US has a huge current account deficit with China, meaning that they've been buying more goods from China than they have been selling to China. And the only way the U.S. has been able to do that is because the Chinese government has been willing to lend to the U.S. And China usually has a lot of debt, is a net creditor as far as the U.S. is concerned, meaning the U.S. actually owes China a lot of a lot of money because they've been actually lending the U.S. money to buy goods from abroad. So every time you lend to the U.S., what do you do? You actually buy treasuries. By buying the treasury, you're actually lending to the government. So the current account deficit has been driving up the price of treasuries. And the changes in the current account deficit, change in international trade now will not only have an impact on the exchange rate, on the currency markets, but also on the treasury markets. Okay, it can also make stock markets nervous, okay, for whatever reason. Interest rates are very, very important to financial markets. Basically, an interest rate is the cost of borrowing if you're a borrower, or the price for lending, or the return from lending if you're a lender. So it depends on which side of that agreement you're at. And interest rates over the last 9 years, well, from 2000 to 2009, the annual lending rate has sunk. Now this is the Bank of England's base rate that we're looking at, and currently stands about 0.5%. And in the last Monetary Policy Committee meeting they decided we are not going to raise that. They kept it at 0.5%, so it's pretty low. Right. Now interest rates are important because for many reasons. One of them is the you know, if you're in the stock markets, the required rate of return is determined by, among other things, the rate of interest. Because if you do a very simple present value discounting equation, you're either, have you learned present value discounting in corporate financial management? So if you're doing a present value discounting equation, you need to consider the rate of interest, right? And the present value discounting is the principal divided by 1 plus R, isn't it? So as R goes up, the present value actually comes down. Okay. So if interest rates are going up, what you, under normal circumstances, see is an exodus of capital from the stock markets to the bond markets. Okay. Now, the government budget is also very important. It's in the headlines. It's been in the headlines and it's still in the headlines because you have deadlock in the U.S., where the government, or part of the government, has effectively shut down, and simply because the Congress, or the equivalent of the Parliament over there, has not reached agreement to pass the new bill. The thing is that every year the government has to approve a budget, has to approve the amount they're going to spend, and right now you don't have any agreement among politicians over there whether they're going to approve it or not. So if you're not going to approve the budget, that means the government is not going to spend. If the government is not going to spend, then all its services are going to come to a halt, right? And that's why public sector workers out there, have just lost their jobs or being told to stay at home until a decision is reached. How many of you are keeping up with that? Okay, right. Very good. Very good. Very good. Very good. Now the rest of you, you're not keeping up with it. That's what I'm seeing here. Nice. I don't understand how you're going to now manage £100,000 even if it is fictitious money, without keeping up with what's going on in the outside world, because that affects the financial market. So you need to be keeping up with this with the latest news. Now, so if that is now what I'm trying to represent here with this big building. That's what we call the treasury. Okay, and That's the Treasury, and the Treasury receives income, and it uses this income to spend on various public sector projects. The main source of income for the Treasury is the taxes. For both the U.S. and the U.K., taxes form the main form of Treasury income, and it spends this money on things like health, defense, education, so on and so forth. So that's the balance. Now, sometimes it can happen that the income, that the spending is greater than the income. So here you have a situation where it's spending more than it's earning. How can a treasury spend more than it earns?
By bonds.
By bonds.
Borrow.
Borrow. And that racks up the size of the debt. Both in the US and in the UK, the size of the debt is in the trillions now. Right? It's a huge level of debt that is there in the UK, and that's another issue in the US, because the level of debt in the US is very high right now. The question that the question that politicians have to decide is, are they going to approve spendings to finance that new level of debt? Otherwise, what happens is the same case with Greece. You default on the debt. You say, we as a government, we as a country, we cannot pay our debt. We cannot service our debt on time. So just as an individual, if you cannot pay back your mortgage on time or your personal loans, what happens to you? You get declared bankrupt. Right? Same thing with the country. If the debt level is too high and the country cannot finance its debt, then the country goes into effective national bankruptcy, and that's what we call sovereign defaults. Right? So in the U.S., you have a very critical situation where the debt level is very high. Now there is what we call the credit rating, which we'll be covering in our second lesson, but I'll give you a glimpse of it. Now there are three companies that carry out credit ratings. There is Standard & Poor's, then there is Fitch, and there is who's the other one? Moody's. Okay. They carry out what are called credit ratings. Standard & Poor's, they give what is called a AAA rating. AAA rating is outstanding. That means if a government issues a bond, a treasury, and this treasury bond is classified as outstanding, AAA. That means you got nothing to worry about. This country is safe. If you invest in this bond, you will near 100% chance you will get the money back. It doesn't get any better than that. But if it starts slipping down, like you got a double A plus, and then you get a BB, it sort of goes down the sliding scale. So the credit rating actually gives investors an idea of how safe an asset is. Recently, the UK's credit rating actually came down, and the reason for that is a high level of debt. If the country is already in a high level of debt, there are going to be concerns as to whether it can finance its existing debt and whether it should be taking on any more debt. Okay. Just to highlight how significant the level of debt in the UK is, if you take the whole of the GDP in the UK, that's the total value of goods and services that the UK economy produced, and you say what percentage of that was debt, was the government debt or public sector debt. 66%, the debt of the UK government is 66% of GDP. So that's how significant the debt situation is for us. Now, When we talk about GDP and when we talk about any value, there are two different dimensions to it. One is what we call the nominal, the other is what we call the real. The nominal is simply the value of the value in pounds and pence. So what we measure or what we publish in terms of pounds and pennies, that is what we call the nominal. The real, so for example, in 2011, the nominal GDP for the UK was 2.48 trillion pounds. Now, the problem with using the nominal value is that the value can change next year, not because the actual GDP has gone up or gone down, but because the price level has changed. So when the price levels change, the value of the nominal GDP changes with the price level. So what we want to do is get the price level out of the equation. So here we are asking the question, not what is the value of it in pounds and pence, or what is the money value of it. Well, we are asking the question, what is the real value of the GDP? The real value of the GDP should, in theory, represent the value of the actual production, not the monetary value of the production. So what we do is we take the nominal GDP and we adjust it for inflation. And once we adjust it for inflation, we have the real GDP. And the real GDP can be regarded as the quantity of production, the value of production. So the real GDP in 2011 was actually 2.25 trillion. So you can see 2.448 there, and then 2.25 here, right? Which is actually less than 2.48 because it's the nominal GDP is higher because of inflation. To get the real GDP, you have to get out the inflation.
Usually, is the GDP start the real GDP and nominal.
Normally statisticians tend to use deflated GDP. That is, you take the real GDP and you look at the growth of the real GDP.
At the end of the year,
Yeah.
get the real
Yeah. You can calculate end of year. You can calculate every quarter. Okay. So they use something called the GDP deflator. They calculate something called the GDP deflator. The GDP deflator is the ratio of the nominal GDP to the real GDP, and that shows you the average prices in the economy. Okay. Now, you may have learned about demand and supply when you did your economics courses. For an economy as a whole, you have demand and supply dynamics. But we don't call it demand supply. We call it aggregate demand and aggregate supply. So that's what the AD and the AS stands for. So the AD stands for aggregate demand, and the AS stands for aggregate supply. Now, if the aggregate demand were to increase, look what happens. So the aggregate demand actually increases, and that will actually drive up the prices. The lines are not straight. Sorry about that. Okay. Let me just erase all that. Okay. So the aggregate demand actually increases, and as a result, the prices actually go up. Okay. So increase in aggregate demand is a good thing because the economy is growing, because the national output actually increases, and this gets registered as a growth in the GDP. But the flip side of growth is what? Inflation. That's the downside of it, because growth actually causes the prices to go up. If you think about it very, in common sense speak, if people are, if there's greater demand for goods and services, companies will have to produce more goods and services. Therefore, there'll be more employment. People will be getting more jobs, and people will be getting salaries. And what do they do with these salaries? They start spending. This spending actually causes the prices to go up. right? And therefore there's inflation, right? So that's the flip side of growth, and that's something you need to keep in mind. There's a question and there's an equation about what causes aggregate demand to change. There are 4 dimensions to aggregate demand, or 4 components of aggregate demand. First is consumption. Consumption is the value of all consumer goods. It's how much is spent by households like you and I, private individuals, on consumer goods, things like food, washing machines, electrical items, for private consumption. Okay. So that if consumer expenditure goes up or goes down, that will cause a change in the aggregate demand. Investment expenditure can also cause a change in aggregate demand. We also call it capital expenditure. This is the value of what is spent on by firms, by companies, on things like machinery, factories, etc. And what you got to keep in mind here is that firms will spend more on investment if they believe that there is going to be likely growth in the future. Okay, so if they expect future growth to be high, then they will actually invest more money, and the investment expenditure will go up. The government spending can also cause changes in aggregate demand. So if the government decides to spend more on public sector goods, things like roads, hospitals, defense, if they increase the level of public spending, that will cause a demand in aggregate, an increase in aggregate demand. Net exports is the difference between exports and imports. If there are more, if there's a greater demand for exports compared to imports, that'll cause the net exports to go up, and that will also drive the level of aggregate demand up. So those are the 4 basic components of aggregate demand, and changes in any one of those can cause a change in aggregate demand, which in turn has an impact on GDP, employment, and inflation. Right? So if aggregate demand goes up, what happens is output goes up, and output goes up means GDP increases, we have economic growth. Unemployment comes down because people are finding more and more jobs, but inflation also goes up. Okay. Now, one thing you got to be aware of and pay attention to is the business cycles, because economies, as you will observe, they may be growing, or they may have been growing over their history, but they don't really grow in a straight line. They tend to have short-term fluctuations. And economists have observed that these short-term fluctuations can have patterns, that there are patterns that they can identify in these short-term fluctuations. You'll have a period where the economy is in high growth, and then you'll have a period where the economy is slowing down, and then you have periods where the economy is turning back up, then turning back down. So they have seen cyclical fluctuations in economic growth. And this is what they call the business cycles. Okay, and there are different stages of the business cycle. There is the peak, and there is the recession. There's a peak or a boom. There is a recession. There's an expansion period or recovery period. So knowing which side of the business cycle you're on can be useful, because if the economy is in boom, that means output is growing, people are finding more jobs, and employment is high, but also prices are also going up. Okay, if it's slowing down, you have a period of recession, and we're just recovering from a recession. This period where it's sort of going back up, that's the recovery phase. Here is actually expanding and then is going back into a peak. So you got to be aware of the fact that businesses go through these economies go through these cyclical fluctuations, which we call the business cycle. There's a question, what causes the business cycles? Well, the business cycle tends to be caused by changes in the investment level. Or that is certainly one school of thought. And recent research, or not so recent research, has found that there's a correlation between business cycles and the changing level of investments. I've just sort of simplified it to give you a sort of an understanding of what the argument is. Now, the thing with investment is future looking, is future oriented. It's always trying to look into the future, what's going to happen in the future. Because if you're a company, for example, and you are going to invest 100 million pounds in building up a new plant, a new branch, a new factory to produce more, then that 100 million pounds is going to be a sunk cost for the next 20, 30, 50 years. So you're looking at the market conditions ahead of time. It has to yield a rate of return over that long-term period. So if you're an investor, if you're doing an investment appraisal, you're always future-oriented. You're interested in what is going to be happening in the future, the future outlook. Okay. Now, and investment actually responds to the changes in the growth rate. It's a very simple example. I've just simplified it or oversimplified it to give you a clear understanding. Let's say the growth rate in the GDP in 2010 increased by 1% compared to 2009. Okay, so 2009 to 2010, GDP went up 1%. 2010 to 2011, GDP went up by 2%. Okay, so the annual increase, what we're talking about here is the annual increase in GDP. Now, the thing with investment is, this is the way they will look at it. When investors look at it, when companies that are looking to invest consider this, they look at output went up by 1% in 2011, but it went up 1% the previous year. So it increased from 1% to 2%. What does that mean? It means it doubled. It went up by 100%. The rate of growth went up by 100%. 2% is double 1%. And this is the way that the economy will see it, or the business economy will see it. They'll see it as a doubling of growth. And when you have that scenario, what businesses are going to do, what investors are going to do, is they're going to be very optimistic about the future because they're seeing a doubling of the investment. They're not looking at it from the point of view of 1% or 2%. They're saying, it changed from 1% growth to 2% growth, which means it doubled, and we're going to pump in the investment. And that causes an acceleration in the investment rate. And that's what is that kind of adjustment, that kind of overshooting and undershooting that tends to lead to the business cycles. And that's why you have moments where investment is very high and there's overinvestment in the economy. And the reason for that is expectations are borne out of future outlook. And that leads to something known as the accelerated theory, which says that the level of investment depends on the rate of change of national output, and as a result tends to be subject to substantial fluctuations. So one school of thought on what causes the business cycles is the fluctuations in the levels of investment, which are responding to changes in the rate of national output. And this causes investment to be more volatile than the gross domestic product, than changes in the gross domestic product. Okay, we're going to stop on that today. What I want you to do for your tutorial is I want you to go onto Blackboard, and on Blackboard there is a discussion that I've put up to do with what is happening in the economy today. So if you go on to discussions, let me just turn the recorder off. So I need you to go into discussions, and it says discuss the economic factors that have a significant impact on the financial markets. Okay. I want you to note. I want you to look at significant current factors, not previous factors, but things that are happening now and the things that will have an impact in the near future. And I need you to post a discussion on your site. So what you will see is you will see that, and you click on that, and to start a discussion you've got to click create thread, and you put a discussion there. Okay, so I will say start a discussion, and I would say start a discussion on the significant economic factors, and then I click submit, and then it will appear there. So so I'll be monitoring as to how your discussion is going. So I'm expecting everyone to sort of put a discussion thread up there. Now we've still got about 50 minutes. In those 50 minutes, I need you to pair up, right? And let me just turn the